What is the geopolitical impact on commodity supply routes? Imagine a world where a single political event can ripple through the entire flow of essential raw materials. That's the power of geopolitics over commodity supply routes. When tensions rise between nations, it can cause major shifts in how commodities like oil, metals, and agricultural products move around the globe. These shifts can lead to delays, higher costs, and unpredictable prices, which directly impact investors and industries alike. Maritime routes are especially sensitive to geopolitical issues. For example, the Red Sea has become a key hotspot because of attacks on ships by groups like the Houthi rebels. These attacks force shipping companies to reroute around the Cape of Good Hope, adding weeks to their journey and increasing fuel and insurance costs. This diversion means less traffic through the Suez Canal, which is a major route for oil, metals, and food supplies. When fewer ships pass through, prices can spike quickly due to supply shortages. The Panama Canal also faces challenges, especially from climate change-induced droughts. Reduced water levels limit how many ships can pass, slowing down trade between Asia and North America. These disruptions make transportation costs rise and delivery times less predictable, which can cause sudden price swings in commodity markets. As traditional routes face pressure, new pathways are emerging. The middle corridor connecting China and Europe saw freight volumes jump significantly in recent years. Rail volumes from Kazakhstan increased over 60%, showing how traders are finding alternative routes. These new routes change where commodities are delivered and when, which can influence prices and storage needs. Trade tensions between countries also play a big role. When the United States imposed tariffs on Chinese goods, the cost of shipping critical minerals from China to the United States soared by more than 70%. Future tariff hikes could cause similar disruptions, creating both risks and opportunities for traders. European trade policies, like subsidies on electric vehicle parts, can lead to retaliatory tariffs on European exports. These trade fights shift demand for raw materials used in manufacturing, affecting prices across metals, energy, and food sectors. Sanctions are another factor. Western sanctions on Russia after its invasion of Ukraine pushed energy markets to find new suppliers. This caused energy prices to stay high and opened opportunities in regions like the Middle East. Countries also restrict exports of vital raw materials to protect their national security, which fragments markets and creates supply shortages. Traders who can identify regions with fewer restrictions can profit from these shortages. Regional protectionism is reshaping global trade. Countries like India are raising tariffs to support local industries, changing where commodities are bought and sold. Trade blocs like the African Continental Free Trade Area and the Regional Comprehensive Economic Partnership are also shifting supply flows. Investors need to watch these regional changes because they influence demand and price differences across different parts of the world. Competition over critical minerals is fierce as nations seek to secure supplies for energy transitions and industrial growth. Countries are investing in overseas mining projects to ensure access, creating opportunities for new production facilities in strategic locations. Energy security remains a top concern, with conflicts, cyber threats, and climate change threatening supply stability. These risks often lead to higher prices for oil and gas, which traders can analyze and use to position themselves advantageously. Companies are also adjusting their supply chains to reduce risks. Many are diversifying suppliers and moving closer to home, which increases demand for local raw materials. Nearshoring and onshoring efforts support prices in developed regions, as they relying less on distant suppliers. These changes create new demand patterns that investors should follow closely. Geopolitical events often cause sudden price jumps. Higher transportation costs, supply restrictions, and demand shifts all contribute to volatility. Prices can differ greatly from one region to another, creating arbitrage opportunities for traders who understand the geopolitical landscape. For example, a commodity might trade at a premium in one country but at a discount elsewhere, depending on trade restrictions and regional tensions. Finally, keeping an eye on new trade routes and their usage can help investors predict where demand will grow or shrink. Monitoring tariffs, sanctions, and trade agreements allows traders to anticipate disruptions and adjust their strategies accordingly. As supply chains become more regionalized, understanding these shifts becomes even more important for making smart investment decisions in commodities.